Hi, everyone, and welcome to another installment of Academic Insights. Today, we're going to talk about ARK Invest big idea with smart contracts. Today, we have Jorden Woods. Jorden, can you introduce yourself and let everyone know what you do?
Sure. Well, Justin, thanks for having me on the show. And so my name is Jorden Woods, and I'm one of the founding partners at StarChain Ventures here in Silicon Valley. We're a venture studio, and so we have a lab and we spin up companies that are focused on Web3 and looking to see how Web3 can transform, society, tech, and basically make a better world. We also have an advisory. So we also advise Web3 startups and do work with large companies as well.
Sounds excellent. My mute button didn't want to go off there. So I know we had a great conversation. The conversation went about an hour and a half last week when we were prepping for this discussion. So can you because you kind of had like a little tier, like a hierarchy where, when we're talking about smart contracts, you kind of have a hierarchy where you had it at the global level, then you talked about enterprises, and you talked about, financial inclusion and micro lending. So not sure how you want to peel back this onion, but I want to get your thoughts on how we can leverage smart contracts outside of, traditional DeFi and NFTs and things like that.
Sure, I'd be happy to talk about that. First, let me just take a moment and just talk about smart contracts and blockchain. So I published a book with my co-author, Radhika Iyengar-Emmons, and that book is focused on enterprise blockchain, like you mentioned, Justin. And so that book was published in 2019. It's an Amazon bestseller. It was an Amazon bestseller when it came out. And it really talks about, all of the use cases and, how these technologies, these decentralized technologies can be used to, again, like change society, make things better. And, so if you think about a smart contract is a self-executing program, and it executes once it receives specific information from different parties that are in the contract. So, for example, if I wanted to send you money, Justin, right? What I could do under our existing system, like a Web 2.0 system, is I would go to a bank, or I'd go to, an online service, and this service would act as an intermediary, building trust between you and me to make sure that the funds are transferred. Because, we don't want to lose money and we don't necessarily, we may know each other, which would be cool. But in a lot of business types of, interactions, you may not have a great, strong or trusted relationship with the counterparty. And so the bank will come in and make sure that you get your funds if I'm sending you money, and that the amount was transferred, and there aren't any disputes, right? Like you say, hey, you didn't send me the money, and I did, or I said I send you the money, and you said I didn't get it. Maybe you didn't send it, right? So the smart contract, kind of acts as that intermediary. But because it's just a program, it basically creates what's called a trustless interaction, right? I don't necessarily need to trust you. There's no intermediary. I just trust the network to make sure that, whatever I'm sending you gets sent to you. And then we can both go online and we can look and see, because there's extreme transparency with, permissionless blockchain networks. And we can see that, yes, indeed, I sent it to your wallet, you received it. And so there can't be any disputes because we have a shared ledger of the transaction. And so everybody, kind of says, okay, everything was fine and no intermediary is needed. So that's like a simple case of a smart contract. Obviously, smart contracts, as the name suggests, can do any kind of interaction between different parties. You can have multiple parties, you can have multiple kinds of activities, you can do escrow, you can do timed kinds of events. So if something happens, then something else happens. And then if something else happens, then you can have these chained together. So you can also have big collections of smart contracts that are working across a lot of different parties. And these are called smart contract networks. And I think, Justin, this is really what we want to talk about today, are these smart contract networks. So not just a single smart contract, but lots and lots of smart contracts that are carrying out a lot of different transactions between a lot of different parties. So, one of the use cases that a lot of people talk about is DeFi, or decentralized finance, because, if I don't need trusted intermediaries like banks or, financial services providers, I can actually provide a lot of the functionality that we have with banking or with, financial services, just with these smart contract networks, if they're built, correctly and, tested, and everybody makes sure that they're doing the right thing, right? So over time, you can build these decentralized finance networks and get a lot of the same functionality that you would, but there's some improvements, so what kind of improvements could you have? Well, when you do a transaction, there's always some kind of fee involved with the intermediary, right? Because they're doing a lot of work, and they are getting involved in the process, they're building trust, and so they charge for that service. Well, with smart contract networks, because it's just a self-executing contract, and there's no people, involved with the process, the fees can be a lot lower, right? So, if you're doing a cross-border kind of money transfer, you might know that you might get charged $50, right? If it's an international transfer, or maybe it's like a remittance, right? People sending money back home overseas, and the fees can be pretty high. They could be 10, 20, 30%, right, of the amount of money that you're sending, which is quite significant. But with a smart contract network, your fees may be like a fraction of a percent, right? So it could be really small. So you can save a lot of money, right? So that's going to be an advantage. So one advantage is that it's a lot cheaper, right? It's much less expensive. Another thing is, when you do a transaction, if you've done international transactions, they don't happen instantaneously, and remittance typically doesn't happen instantaneously either. There might not be just one intermediary, there could be a lot of intermediaries. And so it could take 3, days, 2 days. It's going to be quite a bit of time. If you're going over weekends, there's holidays, you could lose like a week, right? And so there's a liquidity kind of an issue. If you worked in the blockchain ecosystem, you can get instantaneous or nearly instantaneous settlement, right? So the other thing that's really good, if you're moving money around, is that it's got low fees, but sometimes the time value of money is more important, right, than just the fee structure, right? You'll pay more if you can get money faster. Well, with a smart contract network, you can have instant settlement, which means you're kind of like having your cake and eating it too. You've got really low fees, and it's super fast, right? So you can carry out these transactions cross-border. You can carry out pretty complex transactions, and the cost will be low, the speed will be high, and so those can be really attractive to people that are working with, the money sector. So I'll just put that out there for now, that's kind of a starting point. And I'm happy to go into, more details, but let's just start there.
Yeah, let's start there. I can see where this might be a 2-part or a 3-part interview, which is fine because this is some good stuff, because you brought up a few good things there. And whenever we talk about So whenever you say it's going to be interacting with multiple smart contracts, one thing that is very interesting to me is how are enterprises going to be, how are smart contracts going to be leveraged and used by enterprise?
Mhm. Sure. Yeah, there's a couple different ways. There's it's all kind of like back office oriented. So what do I mean by that? What's back office oriented? If you've ever done like B2B kinds of transactions, or even business to consumer, business to business transactions, there's a couple different things that are important. So one of these things that I was just talking about has to do with settlement process, right? So the settlement process, when you're waiting for your money to be in your account. So someone says that they're sending you money, and then you get money in your account. There's a process that happens. That's why it takes a long time. And it's because we have a regulated industry. And so what the process is doing is it's trying to make sure that there aren't these disputes that I talked about at the very beginning. Like someone sends money, you want to make sure that the right amount gets transferred to the right account. We've all read about these examples of somebody wakes up and looks at their bank account and there's too much money in it, or maybe the money is taken out and they don't know where it went, right? Those are bad situations with money, right? It happens from time to time, but you want to minimize those kinds of situations because there's knock-on effects, right? If somebody's getting money, then probably somebody is losing money. And then, there's opportunities for fraud and, all kinds of disputes and lawsuits, etc. So the most important thing about the financial system is that it accurately moves the right amount of money from the right account to another account, right? So that you don't get these kinds of disputes. Now, this process on a back office, like when, banks or institutions or companies are transferring money, you have one bank account, which, transfers money to another bank account, and you have a process between banks. It's called reconciliation. They have to make sure, because they're moving thousands or tens of thousands or hundreds of thousands of transfers every day, right? It could be even millions, right? And so they have to go through all of their books and make sure that every single one of those transactions was done accurately, right? The right amount of money was debited from the right account, and then the other account was credited. Now, what happens is that when you're moving between institutions, one bank can't see the accounts in another bank, right? In a Web 2.0 centralized world, everybody's accounts in a different institution are things you can't see, right? So you can't see what happened in another account. So that's different in the blockchain world. In the blockchain world, you have what's called a shared ledger. And so you can look over at the other wallet and you can say, oh yeah, it's there, it arrived, everything's good, right? So it takes like no time, right? You just go on, you look at the block explorer, and sure enough, you see that it was picked up in terms of the transaction, it went into a particular block, and then the wallet you were transferring to is showing that, it was credited. So it's a really fast, transparent process. In the Web 2.0 world, you can't look across at the other bank's accounts and see that the amount was transferred there. So there's usually a process where you go through reconciliation, where the accounts between the banks are shared, usually through a third party, and they just make sure that the right amounts have been debited and credited on both sides. Now, if there's a dispute, nobody really knows who's right, right? This is the issue. Who sent what? All the information is on one side or the other, right? If one account got $10, but the person said that they sent 20, nobody really knows that, right? You're just looking at numbers, and those numbers don't add up. So what happens in a reconciliation process is there's phone calls, there's faxes, there's, emails, there's text messages that go back and forth between these different institutions. to kind of say, oh, well, we sent 20 bucks. You only received 10? Okay, well, that's a mistake, right? So they have to kind of communicate with each other and fix the ones that aren't correct. And so it can take some time to settle. And so this is what happens because you don't have visibility to, what's going on the other side. So if it's 10 bucks, it's like, okay, it's not a big deal, but, suppose you're moving millions of dollars, right? Or, you're looking at interest on millions of dollars or hundreds of millions of dollars or things like this. Then it starts to get kind of, people get concerned because you're starting to deal with large sums of money. And then you have liquidity, right? People want to have rapid access to this. So this whole reconciliation process impacts liquidity, in a company. We saw this happen with the SVB collapse, right? And we've seen it with Celsius and others and FTX. When the money you thought was there is not there, it creates a lot of knock-on effects, right? As an enterprise, you can't pay payroll, you can't pay, for certain products. You can't do things that you thought you could do because the amount of money is either wrong or it's under dispute, and so it's no longer liquid. So being able to reduce the time for reconciliation between different systems and different banks and different institutions and businesses, et cetera, is really valuable. And so enterprises like to make sure that the institutions that they're working with have a really fast reconciliation process, and that can be facilitated by blockchain. And then, that can be used in these international transfers, right? That a lot of multinational companies, they've got offices all around the world. And when you're transferring money, you've got a liquidity gap, right? So the company that is transferring the money no longer has access to certain funds. And then the office that you're transferring it to that needs that money, for payroll or paying for, office space or whatever they're paying for, that is also in limbo, right? There's this gap in time where the money that is, it's owned by a company, it's their asset, isn't really usable, right? So the company and its international offices are waiting for something to settle. And that's kind of a nail-biting time, right? If that money is important for certain time-sensitive operations. So these are things that happen every day, but again, it leads to these liquidity issues. So being able to have much faster processing and obviously lower fees are very important. Another important thing for enterprises is getting paid on time, by the people that they work with. And if you've ever worked, with a large company, that they can have 45-day, 60-day kinds of terms for payment. So you carried out some kind of, task or activity that was, payable. You've received your purchase order, and then it takes time to get the money. Could be 30 days, could be 45, could be 60. But sometimes it's not 30 or 45 or 60, right? It's supposed to be 60, but you get it in 80 days, right? There's, people are like, yeah, we're going to get it to you, but it's late, right? And so now the enterprise has been floating kind of this period, 30 to 60 days. All of a sudden, it's kind of, wow, it's not 60 days, it's 75 days, it's 80 days, right? And that's, again, can lead to this crunch. You're expecting money at a certain time. Businesses operate on certainty, right? You're going to have money at a certain time so you can do something. Well, if you put the transfer into a smart contract, and so a certain period of time, passes, and then that money is supposed to be transferred instantly, that gets rid of uncertainty, right? Because the smart contract, like we talked about at the beginning, it just executes when certain parameters are met, right? So a certain amount of money has been transferred into the smart contract, certain period of time has passed, and then it's supposed to execute. it's not going to say, oh, I'll do it after the weekend, and, then there's a holiday and it'll say, oh yeah, I'll do it at the end of the week, right? Which can happen when you're dealing with people. It's like, oh, I didn't see that, right? I'll get to that later, right? Which can happen. So instead of this, you can get paid on time, basically, right? So you're supposed to have payment within 60 days, you get paid within 60 days or at 60 days. So smart contracts basically provide certainty in a very uncertain world where people, are, they're busy, they get distracted, they forget things. But the smart contract doesn't forget, right? It does what it's supposed to do. And so there are businesses that have grown into unicorns just on this, right? Getting companies paid on time, right? Because that's really important. There's a lot of different cases like this, that time sensitivity, liquidity, reconciliation, transfers between different countries, all of these kinds of things where you have liquidity, gaps, are very important for enterprises because everybody wants access to their money when they need it. and you want certainty around when you're going to receive money. And then, there's another thing, which is audit trails, right? So if there are disputes, right, which there typically are, but smart contracts can really reduce the number of disputes because it makes sure that everything is visible to everyone at every time. Disputes happen because you can't see what's happening within another organization, and they do things that you don't expect, right? And you don't get what you expected, and you don't know why, right? So all of that kind of figuring out process of what happened, what went wrong, that takes time, right? So that can lead to further delays. And then it can lead to, lawyers and, companies hitting, each other with lawsuits and all these kinds of things that just waste time, waste money, and they impact liquidity, because all people really want is they wanted to get paid, right? And they didn't get paid and they want to know why. And the company is trying to figure out why they couldn't get paid. And now they're trying to deal with it. So not only do you have visibility, but you have complete visibility of the transaction throughout the entire process, right? So you have a full audit trail of what happened. Now, maybe something went wrong, right? The amount that was put into the smart contract was incorrect. So yes, you got paid on time, but you got the wrong amount, right? So that could be, any number of problems, but you can quickly find it and you can see, oh, okay, as you're doing the audit, this wasn't something malicious. Somebody wasn't trying to do anything, improper. It's just there was, and some kind of a typo that happened, and that information is then visible, but you can quickly find it. You see that the initial transaction, it's visible, it just had the wrong number in it, and then that can get traced back if it's an open system, or at least the company can see, oh yeah, you're right, we did put the wrong number in, right? So you didn't get the right number. So this is the thing, is visibility. Visibility is very important for trust, right? Being able to say, I trust, that you were doing the right thing, or that, I want to continue to do business with you. Because, if you think about it, if you don't get paid on time, and the company that you're doing business with is just doing things that don't look above board, they're not paying you the right amounts, they're not paying you on time, it keeps happening over and over again, you may not want to do business with them anymore, right? Because it's just too much hassle, right? There's too much uncertainty. So building trust between organizations is very important to just doing business in general, right? And a big part of doing business between companies is getting paid, and getting paid the right amount. So these are really important things that smart contract networks, that the transparency of blockchain can provide, and then of course cutting down fees and all this kind of stuff. So these are some of the key reasons that enterprises would want to get involved. If you look at capital markets, for example, when you go and you sell stock, there's a T+2, right? You get the time plus 2 days, right? You don't have access to your funds right away in many cases. So many times you'd like to sell something so that you can buy something else, right? Maybe you're making a different trade. But if you make a trade and your assets get locked up because it takes 2 days to settle, and it takes 2 days to settle because you have reconciliation between a lot of different organizations, right? Company has to do a transfer of the shares from one entity to another. There have to be a lot of record keeping entities that have to get notified. They have to make, you know, that change in their records, and then that all has to get reported. So there's legitimate stuff happening, right? It's not like people are just wasting time. There's real people are working hard to get things done as quickly as possible, but it's not instantaneous, right? So if you can get it down from T+3 is where it used to be, to T+2 to T+1 to, you know, if you traded in crypto, you can basically get it, you know, almost instantaneous settlement. The ideas are that you have you know, liquidity very quickly, and so if you look at you know, companies, they're constantly moving money around, right? They have to look at the market conditions. They're putting money into treasury bills, or they're putting money into, you know, different kinds of instruments. And if they want to move, or they want to sell things in bonds or stock market and equities, or with their own shares, right? They're doing buybacks, or they're transferring you know, shares from one entity to another. All of that takes time, right? And so enterprises, again, there's time and there's also cost, right? There's time and cost, and then there's cost of money, time cost of money. So all of these types of things are ways that if you have smart contract networks, they can be a lot more efficient if, you know, you can have them self-executing, you have the audit trail, you have immediate settlement, you have lower fees, and those are all you know, things that businesses would want. What businesses don't want is they don't want to work with something with a lot of money of their own that they don't trust, right? So they work with banks, they work with other businesses, they work with, you know, and the more amount of money that they work with, the more reputable, the larger the institution. And we've seen that recently, right? With the you know, the flight to equality, as they call it, when you have, for example, regional mid-sized banks that were going through liquidity crises, people did what, right? They took money from smaller institutions that they were worried about in terms of liquidity, and they moved their money to larger institutions. So if you are working with large sums of money, people tend, not always, but people tend to go to a large institution because of trust, right? So if you're going to work with a smart contract network, you might start out with very small sums of money because you don't necessarily, the risk might be high. Yes, there's reward for working with it, but it may appear very risky. So the thing is over time, you have to create a significant trust infrastructure, you know, a sense of trust, a feeling of trust, and for these smart contract networks. And we saw that happen with, you know, cryptocurrencies in general. At the beginning, it was just very few people, and then over time, eventually the institutions have gotten involved, and now there's a lot of institutions that are working with it. But that took more than a decade, right? It took more than a decade for people to build trust. But it's not just, you know, with cryptocurrency and things like this, any new technology, right? It takes time for people to learn to trust it. And so they'll play with it, they'll do pilots at the beginning, they'll, you know, just have very small kind of exposure. And then if they have a positive experience, then they'll continue to work with it, right? And then they will move certain systems over. And then once they have a lot of trust in the system, then they'll work with it, you know, kind of as their main system. But that doesn't happen overnight, right? That takes time. So anyway, that's, you know, some of the reasons that enterprises and large companies might want to get involved with these smart contract networks, but they're going to take their time with it. They're not going to rush into it, and but once they do, they're going to commit pretty large sums, compared to the average person, right? Businesses usually, especially large enterprises, they typically have transaction sizes that are much, much larger than individual people. And so when they move into a space, they're going to significantly change the landscape just because of the types of sums and the amount of people they're going to bring to that particular new tech or that particular approach or method.
Yeah. Yeah, so yeah, that was very good, and I think that that kind of wraps up part one of this discussion. So for part two, whenever you were talking about, so now I want to move. So we talked about the enterprises, and now I want to go into like the ecosystems and the communities and the social impact aspect of smart contracts. Now, I know that, it was very interesting whenever you talked about the table system. And then I know you talked about another example. So I want to start off the second part with, how smart contracts are going to be going into, communities and things like that, and making a positive impact in the world.
Sure. Yeah, that's an area that I'm really excited about. So the enterprise side is great. It's obviously very important. But in terms of the unbanked and social impact, there's an aspect that we haven't really talked about, right? Which is, if you look at decentralized finance, it can increase access to financial services. And so you might ask, well, how does it do that? And so if you look at the typical way that people go and they get loans, and usually you'll go to a bank, right? Or you'll go to some financial institution, and they will look at your credit. They'll make sure that you meet certain guidelines, right? And then, if you meet those guidelines, they'll offer you a loan, or they'll be able to lend you money on specific terms. The higher your credit, the better the terms will be, and the lower your credit, the terms won't be quite as good, typically. So if you look at small businesses around the world, typically they are operating kind of in a subsistence level, right? So they're not really super profitable, and so their financials might not look very good. But they can be in situations like all the time where they need money, because let's say that you get a large order for something. It's like your big break, right? You get a large order for something, and you have to deliver on that order. And let's say it's physical goods. You're moving some item, chairs or tables, or maybe it's ball bearings, or it's grain, or whatever, right? You're moving something from one location to another. You're a small business, and you need trucks, you need drivers, you need boats, you need all kinds of stuff. Well, you don't have the money to actually fulfill that order, right? And so this is a section of called trade finance, right? There's actually this problem. People think, well, how often does this happen? Well, 50% of small businesses globally don't get access to funds that they need in order to do this. And so what's the result of that? Well, there's actually trillions of dollars. I'm not talking billions, I'm talking trillions of dollars, actually close to 10 trillion at any time, that is what's called stuck in supply chains, because companies cannot get access to funds. Okay, so that is because 50% of small businesses get, they don't meet the minimum requirement from a bank to be able to carry something out. Now, that's an example with a company. Well, let's think of a person, right? A person wants to do something, right? Maybe they have a business, or maybe they want to fix up their house or whatever. and they want access to funds, or maybe they want to send their child to school, right? There's 100 different reasons why people need money, right, for something. And usually what you do is you go to a bank, and then but there's a lot of places in the world that people don't have bank accounts, right? There's about 2 billion unbanked in the world. And so the idea of going to a bank is very foreign, because either the bank doesn't exist, or the people, they don't, I mean, the bank exists, but they don't have access to a bank. Or if they try to go to a bank, they, are going to be refused, access because of credit terms or whatever. And then there are people that, because of usually women, where it may not be permissible within society for them to get a bank account. And so this exists in many parts of the world. So you have these situations where there are a lot of barriers to an individual or a small business to get access to funds. We talked about, the large companies, but if we look at the small businesses throughout the developing world, or even in the developed world, and then individuals, the hurdle to be able to gain access to a bank account, and then with that bank account to get access to a loan is pretty high, right? And if you have a small business, you may know you can go to a bank, and you can't get a loan, right? You ask, you submit the paperwork, or they give you loan terms that are not very good, right, for what you want to do. You would look at it and you'd say, wow, those interest rates are high. We just, it creates too much uncertainty for us in terms of being able to pay it back, and we're just not confident. Even though they're offering us a loan, we're not confident that we can, do the repayment right away on these terms. So what are alternatives? How do people get around these issues, right? Because, well, you might go to a friend, or you might go to somebody, a friend of a friend, and say, hey, can you lend me some money, right? I want to do X. It's going to be, good for me if I can get access to these funds. It's good for my family. It's good for whatever. Can you help me out? And maybe they give you good terms, maybe they don't, but, you'll go outside the banking system to someone who has money and can lend to you, right? If it's a family member, they might give you really good terms. If it's not a family member, maybe they don't, right? But you get access to the funds somehow. And that's what happens. It's kind of this informal economy. And if you look at the developing world, Justin, you talked about table banking, right? So if you look at countries like Kenya, where women have difficulty getting access to a bank account, they're unbanked by and large, they need startup capital, right? Or they want to expand their business. What do, right? Because you're making a certain amount of money. Maybe let's say that you're a woman who is making some kind of, crafts, you're making bead work, or you're making jewelry, or maybe you're making baskets or hats or clothing, right? In the developing world, say in Kenya. So what they have in Kenya is something called table banking. It's known as chama, 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 and this allows them to go to community. And it started out that there would be a table in the community that had money, right? On it, you go into a location, there'd be some there, they'd make a record of how much money you took, and then you'd pay it back within a certain amount of time. And it was a way for you as a small business. Now, you wouldn't take much, right? You would take maybe $20, $25 worth, but you could then buy beads, you could buy, maybe you needed a potter's wheel, or maybe you needed to get material, right? Because if you're going to make clothing, you got to be able to buy stuff that you're going to make the clothes out of. So this table banking system got set up to help, and it provided outside the banking system a way for women to get access to funds, and there might be an interest rate. But it would be a reasonable interest rate, and you're kind of amongst sisters, and they would want you to be successful, right? It's not like they're trying to take money from you. They want money to come back into the community because they want this system to flourish. But the idea is that it was sisters helping sisters, right? That's really the concept. And they don't have access to a bank. And because they don't have access to a bank, they don't have access to the lending infrastructure of a bank. So you can do these microloans through the system. And then what's been found is that the repayment rate is really high. It's like 98, 99% repayment rate, very low, because there's a community of women, they all know each other, they might be friends or friends of friends. And so there's kind of pressure to perform, right? To do your thing and to make good on the fact that, you know, you borrowed. And then in future, to maybe be able to put money in. When your business is doing well, you put money in, right, into the system. So that system, interestingly enough, is kind of similar to DeFi, decentralized finance from a lending perspective. And so the difference with DeFi is that it's not necessarily within a community that's close-knit. You know, when you go digital, people can be anywhere, right? You could be in different countries, you can be in different cities. People don't necessarily know each other, but you can build trust because you trust the network. You don't necessarily trust the individuals, but you trust the network. And the concept of DeFi is that people who have extra money, they can put it into a pool of money, kind of like that table with money on it, right? There's a pool of money, and then other people can go and they can borrow that money with an interest rate. There's a record that you took money out, and then you know, put money back as you make it, right? And that's kind of the way all lending works. The difference is you don't have banks, right, involved, and all the transactions are carried out by smart contracts. And then visibility to what's happening is on the blockchain, you know, network, so that you can see what's going on. That yes, you took a certain amount of money out, and you're given a token that you took money, that you put money in, and you know, you're given kind of a receipt that you took money out. And then this is called often like yield farming, or you know, you get yield or interest on your money. It's kind of like when you go to the bank and there's an interest rate, which hasn't been around for a while, but now we have interest rates in banks that are, you know, significant. You put your money in, you kind of in the DeFi or crypto parlance, you do staking, right? What's staking? Staking is you put money in and into a certain place, and you don't take it out right away. And the longer you leave it in, you know, the more interest you make on that money. And well, how are you making interest? Well, that money is being lent out and there's an interest rate on it. And so when people are paying it back, right, that interest rate is higher than what you're getting. And so there's a fee that's taken out by the network, and then you get, you know, some interest rate, which is attractive. So you leave your money in. And the higher the interest rate, obviously, the more money and the longer you're willing to leave it. It's kind of like a CD, you know, like a certificate of deposit. If you lock up your money in the traditional finance and TradFi for a year, right, you'll get a higher rate of return typically than if you just lock it up for 30 days, right? And the idea is that, you know, you're providing certainty to the network that that money is going to be there. And so you're rewarded with a higher yield or a higher interest rate on your money. Now, the traditional system is based on, you know, banks and, you know, a whole system that is based on trust, you know, within the existing centralized world. The DeFi networks are, you don't necessarily know everybody, right? In terms of the investors don't know who they're lending to necessarily. And it's all basically mediated by smart contracts to make sure that everything is processed smoothly, that there's visibility, that there's trust in the network. There were some pretty good experiments with it in 2021, where the amount of what's called TVL, or total value locked, in smart contracts for DeFi went up over $100 billion, right? So investors were willing to lend out over 100 billion, and I think it got maybe as high as 150 or 200 billion at one point. But I think now it's kind of in the high double digits, maybe 60, 70 billion that's currently locked. But the, you know, if you look at the banking system, obviously you're talking trillions and trillions and trillions of dollars. So it's a very small amount compared to if the banking system put a small share into DeFi, or institutions put a small share into DeFi. Actually, I saw a statistic that said if financial institutions put 1% of their assets into DeFi, it would be about $1 trillion. So that kind of gives you a sense of how much bigger it could get. It could 10 or 15x if that happened, right? To become more like institutional DeFi. But in order for that to happen, like I had indicated previously, there's got to be trust in the system. And, you know, a lot of the DeFi did have some pretty high profile cases of funds being hacked and taken out of these systems due to a range of different factors. And we could get into that, of why these things happened. And so there does need to be some more infrastructure put into these systems to make sure that these smart contracts are only as good as the code that they're written, you know, in. And so again, people make mistakes. People are talking about, well, you know, maybe use ChatGPT or GPT-4 or something like this to look and audit these systems. Usually there are audits that take place on these smart contract networks to make sure that the smart contracts are not easily hackable, right? That there aren't certain things that can happen. And that could be a use case, right? Where you bring in generative AI to do a check, or people are being able to check more things with the smart contract, more cases. And if you can do that, then you can make them more bulletproof, right? So that the probability that somebody can game the system and take out, you know, a lot of money and defraud the system goes down. I mean, obviously, we've seen a lot of movies where people rob banks and things like this. So it's not just the DeFi system that you know has these basically, like, you can think of it like you know, it's people robbing the bank, right? Is what's happening in essence. So that's in a lot of movies. You've probably seen that, you know, quite a few times. So what do banks do? Well, they have reserves, they have insurance, right, on the system. So you'll see this now coming into DeFi networks, right? They'll have reserves that are set aside if there are problems, right? That provides additional liquidity. And so a certain amount of the funds will get moved into, and this will come out of the fees that are charged. It'll go into, or maybe the way it was set up, it will have like a reserve. And then you can also have a separate contract. This is where we talked about, like, networks, you know, will have multiple smart contract groupings will come together. So if something happens where the smart contract network loses money to fraud, then you can have an insurance contract kick in, right? And that insurance contract will make the investors whole, kind of like the FDIC, right, has done with the banking crisis that we just saw last month. So you can have a lot of these same types of systems that we have in the TradFi world, you can put into the DeFi world. And you can provide more protection, right, to the investors and, you know, who are in essence the depositors, right? So the depositors are the people, but you also have the people on the other side, right, that are you know, want access to funds that are no longer there. So a lot of these networks can get set up. Trust is going to be built over time. You need to bring in things like insurance, things like reserves, in order to make sure that if there are problems, the network will not collapse because it loses all liquidity. And then, you can deploy these into the developing world. You can deploy these into the small business communities globally, like in trade finance, like, I was just mentioning at the beginning of this section, so that small businesses can have access to funds, maybe, kind of more intelligently. One of the issues you have with, with the ability to take money out, of a pool, is visibility to your credit score. So also this risk assessment. So for example, if you come to the network and you say, I need money because I want to do something with my business, right? Or I've just received a large order and I can't fulfill it. I can't, buy the materials, I can't transport things, I can't pay my people, because I have to hire more people in order to get this done. Well, what do you want to do in that situation? You want to make sure that what is being told to you is true, right? Do you really have a contract, right? Is this something that so how do you verify that? So having verification, supply chains are really good because you can verify all of the members in the supply chain, right? So say you got a large order for some large enterprise. Well, you should be able to show that you have a purchase order, right? And so you can do a purchase order. Now, typically you could go and do purchase order or invoice financing, right? But those have much higher interest rates. And you might have heard of factoring, right? Where you have really high interest rates. So just because you have a purchase order doesn't mean that you're going to get paid, right? Because you have to deliver first. And so you deliver and then you get paid. But the fact that you have a purchase order can be checked. But the issue is with small businesses is often people don't have the time and the energy to check and make sure that their documentation is correct. Now, if you put that on a blockchain system, a blockchain network where you have visibility to all the people that are in the supply chain, and then you can look and you can see the documentation from the large retailer or whoever it is that's making the purchase. Now you can very quickly do a check. And then once you do that, then you can provide terms, right? And you say, yes, I've checked all your information. And so you reduce the cost of checking to make sure that somebody is doing something legitimately. If you just are starting up a business or you have a business that you want to expand, maybe kind of like going back to table banking, in that situation, people in the community are like, yeah, they have a business. I see them in the marketplace, or I know their sister or their father or their mother or whatever. And yeah, this is all legit. So they can check on it, right? Well, the same thing can happen. You can have trusted information that's placed in that says, yes, this person does have a business. They are trying to do something. You reduce that cost. And then there are ways that you can, get access to, maybe their business has taken off this year, but, if you look at many times when you do credit checking is backward looking, right? It looks at what you did in the past. Doesn't look at what you're doing in the future, right? Like maybe your business has really taken off. And so, there's a trend, right, that you're increasing. So there are new systems that are coming out. They use AI. And these AI-based systems can say, yeah, this is your prior credit score, but we do see trending that is increasing, that just shows that, your business is improving or whatever. So your credit score for the future is going to be higher, so we'll offer you better terms. Or it can just be like, with a lot of DeFi networks that are based on financial inclusion, it's just, you can take out a certain amount without any checks, right? So if you're going to take out $20, we don't need to check anything, right? You can have $20, right? Here's the interest rate, just pay it back on time. And then we're going to build your credit as you use the system. because you're starting at the minimum level, right? And if you want to go above that, then we have to do more credit checks. But if you just want $20 or whatever the minimum is, you're free to have that, right? And then we'll keep track of you. So these are ways to increase access, to financial, to money, to financial instruments, to lending, to help literally millions and millions of people across the world in their businesses, in their daily lives, in their communities that currently are outside of TradFi for various reasons. And this has the ability to tremendously impact financial inclusion on a global basis.
That was good. So can you expand a little bit? This is kind of like the last question I'm going to ask, but can you expand a little bit on this whole concept of how smart contracts are going to impact? This is like a bad term. How is it going to impact investing?
Well, that's a really good point. How can it impact investing? And we have a community, it's called the Astro Sapiens, right? And so I want to talk a little bit about our community because we are very much focused on increasing access and to capital, from people, of basically underrepresented groups. So women, people of color on a global basis, people who identify under different, maybe differently from their gender, or they have different sexual orientation, etc. People in all these different groups usually find, unfortunately, in the financial system, that they are not treated at the same, in the same way as kind of what is considered the norm, right? And so, as a result, because you have discrepancies and disparities, it leads to inequity, inequality, and it means that people who are trying to achieve certain goals maybe follow their dreams, etc., are blocked from being able to achieve the types of things that they want to achieve. So, one thing with table banking, if you look at it, the people that are investing often in the table banking aren't outside the community, right? So this is one important thing I wanted to mention. I want to mention here is that, if you look at a typical DeFi, you have people that are trying to get access to money, right, or a financial instrument, and then you have people that are typically outside of the group who are putting money in. In these financial inclusion networks, it's the people kind of bootstrapping and helping themselves, right? In the Chama, in Kenya, for example. And I've seen this in other communities, in Korean communities here, in Vietnamese communities, in Chinese communities, immigrant communities in the US. And the way it works is that the people in the community put something affordable for them into a pool, right? So say I can afford $100, right? But that's it. I can't afford more than $100. And we have, 50 families, right, that are in a pool, and everybody's putting in $100, right? Well, if you do 50 times 100, that's $5,000. So if $100 is a lot for each of us, right? If one of those businesses would get $5,000, that's like a boon. That's like a huge, amount of capital, right? So they can get access to $5,000 all as one lump sum, no strings attached. Obviously, there's an interest rate. There's some kind of a repayment period, but you're among friends, right? And then if your business does well, you can put more money into the pool next month or whenever the next time that the group gets together to set up a pool. So the idea is that you can actually, you're not only increasing the ability of people to gain access, but for someone to be able to invest into, some kind of an instrument and get a return, that bar can be lowered too, right? So if you look at equity crowdfunding, for example, you know, the barriers to investing in startups before the Jobs Act were that you had to be a sophisticated investor, right? You had to be accredited. And in order to be accredited, you had to either have a net worth over $1 million, or you had to be, you know, making 200 to 250,000, depending upon your marital status, for at least 2 years in a row. So that kind of wipes out 90% of the access in the US, for example, to being able to invest in a startup. And that startup can generate a lot of wealth for a lot of people, right? So it's the same thing here, right? If I can gain access to a higher interest rate, you know, well, what's the minimum that I have to put in? Well, with or to startups. Now, with the Jobs Act, the amount and the requirements changed dramatically. So the average person under equity crowdfunding rules, you know, can invest without any kind of checks on their income. This kind of this minimum level, can invest $2,500 now, $2,500 per year into equity crowdfunding projects. Now, if you want to invest more than that, you have to prove higher income levels. But you can invest in startups up to $2,500, and there's a minimum investment of $100 typically. So now, also as an accredited investor, if you were trying to invest in startups, the minimum might be 25,000, it might be 10,000, it might be 50,000, right? Depends on the startup, you know, the private placement, you know, terms, etc. But now you can invest with as little as $100, and you don't have to be accredited, right? You don't have to go and go through all these hurdles. So that has now increased access to basically a much broader, you know, percentage of the population. And so this is the same thing with DeFi, right? You can go to a DeFi pool and you can put in $100, right? And that's kind of like with table banking, right? I can put in $100 into a pool. There's 50 other families. Everybody's putting in 100, but the pool has $5,000. So this is the idea that you can, the community itself can bootstrap, right? To and enable the community to help itself. Now, the issues that you typically have around this come around trust, right? If you are taking larger sums of money, well, who do you give them to? Who do you give that larger sum of money to? And you've probably heard, there's been a lot of stories of these types of networks where somebody who gets all the money, they take the money and they run, right? And, you know, they do a risk reward. They're like, these are all my friends. I've known these people for 10 years. But I'm getting a big sum of money and I'm just going to run, right? It's kind of that risk reward thing. Well, the really nice thing about smart contracts is that the money gets locked into the smart contract, right? And you can set it up so that you can have like a DAO, or a decentralized autonomous organization. So the DAO actually makes the decision of when that money and how that money gets released. And that's also based on smart contracts, right? So rather than one individual making a decision, you can have all the individuals making the decision about how that, right? They're all voting. They all are enfranchised into the voting. They're all, you know, and this is why DAOs usually go hand in hand with DeFi, Treasury, and all this kind of stuff, is because the decision-making process is communal, right? It's community-based. Now it's for profit, right? And everybody is trying to make money, right? So this is capitalism. It's not communism, but you're bringing in all the different voices. And it's a decentralized kind of capitalism, rather than a centralized one. And because the centralized one leads to a single point of failure, a single point of corruption, right? That's what you often see when things get out of hand, right? And so, you know, things go along fine, the sums are small, everybody's happy, but then somebody gets greedy, right? And then things break down if that greedy person is the person with all the money. And, you know, but if you have checks on it with like a DAO, and you digitize everything so that all the information is available to anybody with access, to online, now you increase the trust in the network. Now there can be other vectors, right? You can have, people hack the smart contract itself. So again, going back to this, you got to make sure that the smart contracts are audited. You got to make sure you have insurance, you have reserves, you've got all this kind of stuff. But then the money doesn't go into the hands of one person, right? Or one group, because in that group, just by the fact that they're getting all the money, they get more power, right? Because everybody's like, oh, well, what are they going to do with the money? Well, if the community is deciding how the money is used, everybody has the power, right? So my vote and the vote of everybody else is used to decide how that money is used, right? And then the vote is carried out by everybody, and again, with blockchain, you have anonymity, right? I mean, it's pseudonymity because everybody votes via a wallet. So you can see that all the votes happen. You don't necessarily know who the person is, so their vote is protected, right? In terms of their identity. But you can see that everybody, you have 50 people and you have 50 votes, right? So 50 wallets, 50 votes, and then you can look and you can see, well, people wanted to put the money in this place, right? To this company, or it was transferred. Everybody decided that the money was going to get transferred to this company. And sure enough, you could see it going from the wallet that belonged to the community to the wallet that goes to that company, right? So that all is visible, and then the vote can be seen. So you have complete and absolute transparency to everything that happens in the smart contract network. And so you have increased access from people that want access to capital, and you have increased access to people that want to invest, right, in and get an interest rate by reducing the barrier to being able to do that. And then everybody in the community being able to set up their own pool. And then with that pool can then, carry out these transactions, which are based on this decentralized governance, or they self-govern, how the money is used. And then there's complete transparency to what happened, and there's an audit trail. So those are really the base concepts of kind of taking this table banking or these, more decentralized approaches that are already used, digitizing them, making them safer, making them more transparent, making sure they're not centralized, and kind of empowering the communities to do more and have more faith and trust. And as they get more successful, it doesn't invite, internal fraud, right? Because, everybody is getting richer together, so to speak, and has, knows what's going on.
Yeah, this was an excellent discussion. A lot of great information. We hit the enterprise level, we hit the table banking level, we hit the micro lending level. I think we covered it all, in terms of smart contracts. So Jorden, thank you for your time, and just can you let everybody know where to find you?
Sure. So you can look me up on LinkedIn. I'm under Jorden Woods, and you can also check out our community, Astra Sapiens. We have a group on LinkedIn. And StarChain Ventures. We also have StarChain Ventures. We also have Astra Sapiens Foundation, if you want to check out our foundation, but that's all on LinkedIn. That's primarily where you can find me. And if you connect with me there, then we can chat and maybe move off to something like email. But LinkedIn is kind of my platform of choice at this point. So it was great. Thank you so much, Justin, for this opportunity to talk about these areas that, are a big passion for me. And we're also working with companies that are doing these things. We're supporting them, in Africa. So this isn't, just in our community. We're also supporting companies that are in country, that are actually digitizing and doing a lot of this cool stuff that we talked about. And bringing more financial inclusion to different parts of the world.
Excellent. So thank you once again, and for everyone else, until next time. Thanks.
Thanks so much. Bye.
Bye.